By the end of this video, you're gonna know the top 5 mortgage mistakes that new real estate investors make. Because if you make any of these mistakes, it's a good chance that you're gonna lose your money. By the way, the last one is probably one that's gonna surprise you. But first, I need you to hit that subscribe button. If you want to get better at real estate investing, you need to follow this channel. Also, make sure to sign up for my free 5-day Keys to Home Ownership Challenge coming up on March 3rd. The link to that is in the description. The first mistake is not having enough cash reserves. You might think that all you need to buy a property is your down payment and closing costs, but that is 100% false. I strongly recommend having 3 to 6 months of expenses saved at the point of buying a property. So let's look at a quick example. If your mortgage, taxes, and insurance are $4,000 per month, I recommend having an additional $12,000 saved on the low end or $24,000 saved on the high end. In addition to your mortgage, taxes, and insurance, there are other expenses that come up. 81% of home buyers are hit with significant unexpected repairs within the first year of ownership, according to a survey from the insurance company Hippo. According to an article from bankrate.com, the average American spends about $1,200 to $2,400 a year on lawn care and landscaping. The average cost to clean rain gutters is about $161, and it's recommended that you clean them a couple times a year. And then according to Zillow, these are the metros with the highest hidden cost of home ownership. As you can see, it can range from $17,000 to over $22,000. So this is really something to keep in mind when you're buying a property. The fact of the matter is, anything can happen. You could lose your job, your tenants can stop paying, and a host of other things can happen. So you want to make sure that you're protecting yourself at all costs. Even if your loan does not require it, make sure you have reserves. So this next mistake is one that a lot of people will find controversial. The next mistake is buying more home than you can afford. This is one of the absolute worst things you can do in the mortgage process. So a lot of us want the American dream home with the white picket fence and the big backyard, or the rental property in the most exclusive part of town. And there's nothing wrong with this. But here's something that you should definitely keep in mind. For a single family home that you're living in, or a multifamily home where you're living in one unit and renting the other units out, the mortgage should not exceed 30% of your take-home pay. According to a study done by the U.S. Chamber of Commerce, 27.4% of homeowners are considered house poor, meaning that they spend 30% of their income on housing costs. This is a big problem. As you can see on this chart, these are the cities with the most homeowners who are spending more than 30% of their income on their housing costs. So Hialeah, Florida leads the pack with 60% of their homeowners who are house poor, spending over 30% of their income on their housing expenses. And you can also see that the lowest on the list is about 44%. This is a huge problem, and I do not want you to have to experience this. So if your income is $6,000 a month, that means your mortgage should not exceed $1,800 per month. A lot of people online will say that if you have a multi-unit, you can depend on the tenants to pay the mortgage, either some of it or the entire thing. This is terrible advice, and it's 100% false. You need to be able to comfortably afford the mortgage in the worst case scenario. You have to protect yourself. The same goes for investment properties. You have to be able to comfortably afford the mortgage, whether you're living there or not. Period. You should also never buy at the top of your budget. Here's what I mean. If the max amount you were approved for a property in Texas was $400,000 and you put 20% down on that property, the monthly payment would be about $2,846. If you instead decided to buy a house for $300,000 with 20% down, your payment would be about $2,138. You would save $708 per month and $8,496 per year. The first house does not need to be your dream house. You don't want to be at home eating tuna sandwiches every day because you decided to take a mortgage out that was more than you can afford. Now, this is no hate to tuna sandwiches. I make pretty good tuna sandwiches, and I like tuna sandwiches a lot, but you get the point. Don't buy a home at the top of your budget. There's a 100% likelihood that you will regret it. At this point, there are 3 more mistakes to discuss, and like I said, the last one is probably going to be a big surprise to you. Mistake number 3 is depending on refinancing. Buying a home and justifying the price and the interest rate by saying you can refinance later is a big mistake. First, there's no guarantee that interest rates will fall low enough for it to make sense for you to refinance. Also, refinancing is not free, and there's a number of costs that are associated with it. According to Freddie Mac, the average cost to refinance a home is about $5,000. Obviously, this can vary by the size of your loan, where you live, and other factors, but here are some of the costs that are associated with refinancing. So government recording costs, appraisal fees, credit report fees, lender origination fees, title services, tax service fees, survey fees, attorney fees, underwriting fees are all fees that are part of the refinancing process for the majority of people. You shouldn't buy a home thinking, oh, my payment doesn't matter, I can't afford it, I'll just refinance later. That is a recipe for disaster. Refinancing is nice to have in the future, but you should not be making your home purchase decision strictly based off of the potential to refinance in the future. You are gonna regret it, I promise you. So the next mistake is one of the absolute worst mistakes you can make, and it can ultimately result in your loan getting denied. Mistake number 4 is buying a new car or taking on new debt. So after you're pre-approved for a mortgage, there's a final approval that takes place before you actually close on the property. So during this time, you should not be getting a new car, taking on any type of loan, credit card, or any new debt. This can negatively impact your debt to income ratio and your credit score, which are both very important in the mortgage process. Just wait until after you buy the home to do any of those things. You can wait. It can wait. I promise you. You can risk getting your loan denied if you don't listen to me and you make this mistake. You put in all this work to get to this point and buy this house. Do you really want to miss out on a house because you decided on a whim that you wanted to buy a G-Wagon? I don't think so. Trust me, you will regret it if you make this mistake. The last mistake is one that people make every single day, and I'm sure it's going to surprise you. Mistake number 5 is seeking the lowest down payment possible. All over the internet, you'll hear people talking about buying a property with 0% down or seeking the lowest possible down payment. You might even hear that you don't need money at all to invest in real estate. The reality of it is, those strategies may not be the best thing for many of you watching to do. Let me explain. If you purchased a $300,000 home in Illinois with a 3.5% down payment, it would be about $10,500 plus closing costs. Your payment would be about $2,605 per month. If you put 20% down on the same property, the payment would be about $2,030. That's a difference of $575 per month and $6,900 per year. I am not against low or no down payment programs. I have plenty of videos talking about the benefits of those programs. Some of the programs I've discussed are the NACR program, which allows you to pay 0% down, no closing costs, no fees, and a below the market interest rate. I've also discussed the Fannie Mae program that allows you to put 5% down on a multifamily property. You also may know about the FHA program, which allows you to put 3.5% down on a 1 to 4 unit property. At the end of the day, it's up to you to determine what's affordable based on your personal budget. Explore all the programs and see what makes the most sense for you and your personal situation. For some of you watching, the lower down payment programs would have the mortgage still 30% or less of your take home pay. For others, you might need to put more down in order for the payment to be more comfortable. These are things you just have to figure out. You have to run the numbers and make the best decision for yourself. So now that you know the 5 mortgage mistakes to avoid, I want you to learn about how to buy a property for 0% down. Check out this video right here.